What's up, YouTube? It's the Action Figure Grader coming back to you with another video. And this time we want to talk about a June survey that looked at U.S. consumers and asked them some questions about what they think the economy's doing, how they're doing financially, personally, and what their kind of plan is in place to kind of cover all of these high expenses as it relates to a high inflation environment that we covered in a video earlier this week. And some of the results were actually pretty surprising. There was even a segment in there about selling off items that they owned, and I wanted to talk about that. And just generally speaking, it seems like the middle class is being squeezed. No big surprise there. As inflation runs rampant, runs out of control, and the cost of everyday goods and services goes higher and higher, the middle class in the U.S. is really having a struggle right now staying within their budget. And as a result, credit card debt is going up. All kinds of debts going up. The personal savings rate is going down. And I wanted to talk about what this survey said. So the survey by Primerica Financial, they surveyed 1,400 U.S. households that are in the middle class. And they define the middle class as those making between $30,000 and $100,000. That's a really wide range. And I would argue that the bottom of that range really isn't the middle class. You're talking about $30,000 is kind of barely eking out, living expenses these days. So I question that range, but it at least gives us a nice wide range, and 1,400 households is a pretty statistically significant number. I mean, you're talking from a regression perspective, nerd alert, a pretty wide range of folks, and I think the survey really gives you a nice snapshot as to what's going on in the U.S. So as a result of this survey, 75% of the middle class households say their income is falling behind the cost of living. No big surprise there. We talked about that in the video, I believe, on Tuesday, where, inflation's running at about 9%, and real earnings or wages are only running at 5%. So as a result, really on a nominal basis versus a real basis, U.S. households, they're making less money because they're spending more money because of this high inflation stuff. So let's take a look at some of the other results. There's also been a general uptick in financial worries in the last 6 months. I'm not shocked to see that. 39% of those surveyed expect to be worse off financially in a year. And that's up from December of 2020 of 17%. So that's a pretty big jump. That's about doubling. Well, I don't know the exact math for it, but going from 17% to 39% is a pretty big number. So again, it was 1,400 adults, and inflation's taking a toll on households. The 9.1% number that we covered in June from a year earlier, I don't expect that number to drop off quickly. And real hourly wages showed a 5.1% increase in June from a year earlier. So the cost of goods and services and the cost of living is going up 9%. Your earnings are only going up 5%. So it's becoming more and more difficult to make ends meet. And here are some of the other results. Actions that middle income consumers will take to handle inflation: work longer before retirement. 42% of people said that. Cut back and pause on the emergency fund, and this is something that we've talked about in a number of videos about having an emergency fund set aside. Well, now's really the time where people are going to be extracting from that emergency fund to kind of cover their cost of living, as their income cannot meet current demand on their budget. And delay car repairs and maintenance. Find a higher paying job. That's something that a lot of people are doing right now. Increased credit card usage. We're going to touch on that towards the end of this video and take a look at how consumer debt is increasing. And circling back to a video earlier, we talked about how the guy that was in The Big Short, Michael something or other, he said that consumer savings rates are going to be turning negative by this fall. And this survey kind of backs that, because people are cutting back or pausing on their emergency fund, and they're really taking money out of that, and they're also using credit cards to kind of get by right now. So that's bad. It's bad news there. As we know, the Federal Reserve, they recently raised the target interest rate by 3/4 of a point, and the next meeting is, I believe, next week, July 25th and 26th, somewhere in that ballpark. So we'll see if they raise it by another 3/4 of a percentage point, or if it's going to be 1 full point. I don't know the answer to that, but it seems like more and more there's rumors that the interest rates are going to go up even more than 3/4 of a point. Recession or not, set aside some cash. Big surprise. It's really hard to do that though. You know, when your cost of goods are going up so much. So people are not setting aside money like they probably should. And but you know, that's the point of an emergency fund in my mind, is to get you through these tough times. This is another interesting aspect of this survey. Where are middle income consumers cutting out spending to fight inflation? And I'm not surprised by this, and it kind of piggybacks off of the last video, but eating out less, eating less takeout, 71% of people. 71% of people are doing that. And, you know, just anecdotally, locally, it's unbelievable how much prices have increased for going out for restaurants. We don't do it a lot anyway, just because we have kids and we're so busy with work and kids' activities after school and after camps and things like that during the summer, that we don't even have time to go out. But we do find ourselves going out less, and I'd be curious to know what you guys do during this kind of high inflation environment. Are you guys eating out less? Are you spending less? Are you collecting less? I know I'm collecting a little bit less. This is the big one, though. They're delaying tech upgrades, laptops, phones, and you can include appliances, TVs, things like that in there, 69%. And that also goes back to the video on Tuesday, where copper prices are actually declining because there's less demand for raw materials to go into these finished goods. And as you see copper prices go, it's now in a bear market. And as we talked about, 100% of the time, there's been a bear market for the raw material copper. 100% of the time, there's been a recession after that. And it's tied to this. It's tied to the delay in upgrades to stuff that's kind of discretionary. Do you really need a laptop or phone upgrade, or an appliance upgrade, or a TV upgrade? The answer is no during a high inflation environment where you're just trying to take all your money and put it towards groceries and rent and utilities. Buying fewer clothes and accessories, that's another big one, 62%. Canceling and delaying travel plans. And, you know, over the last 3 to 6 months, travel costs have gone up, obviously, because of fuel. But lately, over the last couple of weeks, there's been a lot of articles out saying that airfare prices have come back down a little bit. And I think that's a demand issue. There's a higher supply. People are traveling less because of the cost of it. And now airlines are starting to see some vacancy, and they're starting to see the need to cut back on their airfares. So driving less, obviously, that's a pretty big one. I know I drive a lot less. I only make it a necessity now, just given that gas prices of where they are. Cutting grocery spending, that they say 49%. I think that it's not really cutting grocery spending, because you got to eat, right? I think it's reallocating your grocery spending towards less expensive items. Do you really need a filet mignon when hamburger will do, or chicken? So I think that it's just taking from one basket of higher priced grocery items and putting it towards less expensive items. And so that's a big one there. And this is the where I wanted to talk about selling things your own. So as of right now, anyway, you got to remember, this is June. This survey was done in June. But where middle income consumers will cut spending to fight inflation, only 25% of them said that they're going to sell things that they own. And I would argue that number is going to increase quite a bit, especially on the collectibles front. Let's tying it back to the stuff behind me, collectibles. I am seeing more job lots of collectibles, both on Facebook and on eBay, where people are just dumping their collections in one big lot. And we're going to talk about a few of those in the vintage collection in the market update tomorrow, where somebody literally sold their entire vintage collection in eBay in an auction, all in one auction. So it was a really cool item to see, just from a pricing perspective. But it's unfortunate, because it's probably a case where a collector is trying to make ends meet, and they fall in this 25% category where they're selling things that they own. And again, my argument is, by the time this fall rolls around, if inflation still remains a problem, which I expect it to do, as corporations start to cut back on hiring, which that's already been announced by some of the big names out there, Microsoft, Google, a lot of the Wall Street banks. That's going to trickle down. Obviously, you have the big AAA blue chip stock companies that are big corporations. If they're already announcing layoffs and hiring freezes, think about the smaller companies as you trickle down. And I think that's going to start to kind of trickle down later this fall. We're going to start to see less hiring and even trimming of their current employment headcount. And I expect people to sell off more and more stuff to kind of make ends meet as we roll into a hard recession. And again, I hope I'm wrong on all this stuff, but I think it's going to happen. And I bet that this number, apparently Primerica Financial, they do this survey every quarter. So this is the second quarter survey in June. And I bet when you start looking at the September survey that they do, and that'll come out towards, mid-October, I bet this number right here will be significantly higher. And I'll try to make a note in my files to look up the Primerica Financial survey in September, in October. It'll probably come out like late October, third week of October. And I'm going to go ahead and take a guess that says that this number, that this 25% number is going to be more like 40% when that Q3 survey comes out. So anyway, here's the company that does it again, Primerica Financial. And credit card debt is the other big thing I wanted to talk about in this video. Credit card debt has declined over the last 3 months, but it's increasing right now. Slowly but surely, we're going to start to see more income or more credit card debt as people rely on credit cards to kind of get them through month to month. And credit card interest rates, the interest rate that you pay on your balance is going up, quite obviously, given that the federal funds rate is going up. Everything is tied to what the Fed does with their target interest rate. And everything from credit cards to revolving loans, home equity lines, auto loans, all those student loans, all those types of things are affected by it and go up in price accordingly. And when you got to pay a higher interest rate on your debt levels, clearly you have less money to pay off the principal. And you can expect a lot of those credit card debt balances to go up even more. So again, tying back to this survey again, it said 42% say they plan to work longer before retirement. I know a lot of people within even my own family who either retired recently or are nearing retirement age. But because their 401ks and retirement plans have gotten hammered so hard by the stock market because they were overinvested in higher risk stocks, they're rethinking retirement, or they're taking on second jobs or smaller jobs to kind of make ends meet because they had such a big percentage of their 401k tied to higher risk stocks. And that's something that I always talk about is like, you have to look at what your age is. Right now, I'm 45 years old, so I'm pretty heavily invested in stocks. I'm probably like 80 to 85% stocks. But stocks are a higher risk investment relative to like bonds or money market funds or corporate paper, things like that. And if you're nearing retirement age, if you're in that kind of bracket of, let's call it 60 to 65 or older, you have to take a look at your portfolio and how it's allocated, how the assets are allocated between stocks, bonds, and cash. And if you're overextended and your risk portfolio and your risk is higher, and you're nearing retirement age, you have to rethink it if the stock market craters like it has recently. So it's something to think about. If you make it through this current storm and we start seeing the stock market like it's historically done go up between 7 and 9% a year, once we get to kind of a steady stasis, if you start reaching that retirement age, you might want to rethink what you're doing in terms of your allocation. And this is a good point. I don't know how good the article is. A lot of it's kind of obvious type stuff, but I like the idea of focusing on your personal economy and not the global economy or not the U.S. economy on a macro scale. And that's something that I do personally. I got hit really hard during the recession of 07 and 08, and I made a decision then that I would never be personally in such financial straits or such high debt level or not enough cash on hand to get through the next downturn. So I focused on my personal economy. And as you know, I've talked about it at length, so I won't belabor the point. But you got your your personal kind of emergency fund. You have to look at your current debt levels. I never carry a credit card balance now, and it's easier said than done if you're right in the thick of it right now. But I would say that for those of you who are carrying heavy credit card balances, is to, weather this storm, do what you got to do to get through it. But when you make it out the other side and you start to get some breathing room, get those credit cards paid off. And for me, I never not pay on a monthly basis to get my credit card back to zero. And I track it every week and to know where my credit card balances are. I know when those due dates are. And I always make sure that I have a good idea of what my debt level is. So I like the idea of focusing on your personal economy versus the macro economy. And it's just something to keep in mind. Take a personal snapshot, get your budget in place, because this too shall pass. There's always going to be a recession. Being in a recession is just something that's going to happen from time to time. And the thing to focus on is not the economy, but your personal economy. So I think that's a really, really good point. Next up, the average credit card interest rate right now is 17.36%. So think about that for a second. If you're carrying credit card debt right now, you're paying 17.36% on an annualized basis right now. And most credit cards are actually higher than that. I would argue that number is probably too low. And it's probably going to be closer to 20% if you look at most credit cards right now. So that's an exorbitant rate. That's like loan shark type numbers, in my opinion. If you need some sort of loan, as I talked about, set up a HELOC, set up a home equity line of credit. Most people who still own their house right now, they've seen substantial gains over the last 2 to 5 years on their home in terms of the market value. And if you got to weather a storm for the next 11 to 18 months, a HELOC is going to give you a much better interest rate versus your credit card. You're not going to be paying 17.36%, at least right now, on a HELOC, but a credit card you are. And that's why I feel like credit cards are not to be used as a true loan instrument. It's really just a convenience instrument where where you can use it instead of paying cash, but pay it off at the end of each month so you're not paying that exorbitant rate. Total household debt increases in Q1 2022. You can imagine what it's going to do in Q2 if it hasn't come out yet. It's going to be coming out soon. But mortgage balances rose by $250 billion in the first quarter. Credit card balances are still $71 billion higher than Q1 2021. So that's a substantial year-over-year increase. I'm talking about the U.S. as a whole. We're up $71 billion from Q1 2022 versus Q1 2021. So, and this article, which I'll link all these articles again in the video description, it just shows you just some of the massive numbers that are out there. Student loan debt, auto debt, credit card debt, those are items that, I made a decision back in 07, 08 that I was going to get all that stuff paid off. I didn't have any student loan debt, but my wife did. Auto debt, we had a little bit, but we paid that off very quickly. And then credit card debt, as I said, I was carrying massive balances back then because I had to get through that downturn, but now I carry a zero balance as best I can. And it's pretty, I'm not going to talk about mortgage debt because I definitely got mortgage debt, but they're all at a fixed rate, right? That's the beauty about getting a 30-year mortgage, is that no matter what the economy is doing, no matter what inflation is doing, if you've got a fixed 30-year mortgage, your monthly payments are fixed with respect to the actual servicing of the loan. Obviously, it can fluctuate based on property taxes, but that's really the only factor. But just some really interesting numbers, and I thought that it would be, it was kind of important to kind of talk about what most middle-class households in the U.S., how they're feeling right now, and trickling it back down to collectibles. I think that this fall is where we're going to start seeing more and more people sell off those collections to kind of make ends meet. And it's an unfortunate thing, and I'm certainly not hoping for it. I'm certainly hoping that my intuition that it's going to happen is wrong. But I do think that number, that 25% number that was in that survey, where was that? Right here. Yeah, right here. Selling things you own, only 25% of responders to the survey said that they're going to do that to fight inflation. And again, I think that number is going to be more like 40% or higher when they do it for Q3. So we'll see. But just wanted to share some more information on the U.S. economy and what people's mindsets are right now. And again, I think we're at the very beginning of the storm, and I expect things to get worse before they get better. If you have any questions, let me know. Please leave a like if you like this kind of information. I'd love to hear your thoughts as to how you're combating the high inflation as it relates to your own personal economy. Thanks again, and I'll be back soon.